every other market, as they have matured over the years, you developed a robust and reliable secondary market to match buyers and sellers. Why would it be any different in private equity? So I think what has happened recently is you've had a lot of capital flowing into private equity, you had stalled exits, you don't really have the distributions going back to underlying investors. So big institutions are saying, I need to, because I've already committed to the next three deals, I need to find ways of getting liquidity in my portfolio. Secondary managers step in. So we really like the secondary space. Again, even if exits pick up and M&A activity pick up and IPOs pick up, we still think secondaries perform a vital cog in the overall ecosystem. Private credit we like, and I'll tell you, we like direct lending, more conservative. We like distressed, but only with experienced managers who can potentially have a workout team. But an area that's maybe a little bit different than a lot of other people is we like real estate debt. So think about the private credit market was really born out of the disruption that came out of 2008. Banks stopped lending, private credit managers stepped in to fill the void. We see the same sort of market environment today with what has happened with SVB. And what is the concern with real estate is banks are not going to lend to real estate. They're just very leery about it. Nobody wants to have a real estate asset on their balance sheet. So I think private credit managers, if they can be smart about it, can find really interesting opportunities in real estate debt. Kind of a counter call, but again, I think that's where the opportunities are. When it is difficult, when there's disruption, when there's blood in the water, that's often when you find the best opportunities. I would say we haven't given up on real estate broadly. We like real estate, but I think offices will continue to be a challenging sector. So we like industrials, multifamily, life sciences. So I think you need to be a little bit more selective when you look at that.
Yeah, it's funny on the Bondrian platform. Our three most popular partners right now, the ones that advisors are most interested in speaking to, are a real estate debt fund, Link Capital, a venture capital almost secondary ish
Hmm.
fund called Vested, which helps employees exercise their options when they exit a startup.
Hmm.
And instead of loaning them the money like a lot of other firms have done, they actually take a piece of those options and put it in a fund. So they get access to a lot of, the startups that you normally wouldn't get access to unless you could invest in the Sequoia fund. And then we have a direct lender, lower middle market, small business. And we really talk to our advisors and their clients about that one in the sense of like it's supporting small business ownership and small business growth, and that's what you're really investing there, and that really resonates a lot with advisors that have entrepreneurs that they work with. So the things you talked about are right in the sweet spot of where we're actually seeing interest too. And I think your comments about secondaries are really interesting. I think the public markets are like the biggest secondary market there is, if you think about it. I
It
mean,
is.
that's exactly what they are. And so creating some sort of secondary in the private markets is really interesting, but it will always, because of illiquidity, you'll always be buying that at a discount, right? Because you're helping somebody who has a need, and you're providing them, liquidity for that need, and you get paid for that. So in my mind, I completely agree with you in terms of the potential for you to be able to participate in private equity deals at a better multiple than the original investors, and that is advantageous to a lot of people, and that can be really a good thing for your portfolio.